Hello, and welcome to our continued discussion of PepsiCo's 2014 annual report. In this video, we will discuss its statement of cash flows, current cash debt coverage ratio, and dollar amount of free cash flow. So, in order to do so, we'll need to dig deeper within PepsiCo's 2014 annual report for more information about its cash flows. And for the ratios, you'll need the statement of cash flows, pages 69 and 70, as well as some information on the balance sheet, page 71. If we look at the consolidated statement of cash flows, the most important section is cash flows from operating activities, which is summarized at the bottom in 2014 as $10.5 billion. Note that PepsiCo, like most companies, use the indirect method. They start with net income, add back non-cash expenses, adjust for changes in operating assets and liabilities to get the cash provided by operating activity number. Like a lot of companies, PepsiCo has less net income than cash from operations if it has non-cash expenses like depreciation and amortization, as well as stock-based compensation expense. Note that PepsiCo must have increased its receivables because an increase in receivables reduces cash flow, and note that it also must have increased its payables. An increase in payables, getting more credit, helps the current period's cash flow. PepsiCo's cash provided by operating activities of $10.5 billion is bigger than last year, where it was $9.7 billion. So PepsiCo generates a decent amount of cash from operating activities each year. Does it generate enough to take care of buying new property, plant, and equipment? The investing activities section of the statement of cash flows has to do with the purchase of long-term assets that stay in the business, like property, plant, and equipment, and intangible assets, as well as purchasing non-operating assets like investments. Capital spending means purchases of property, plant, and equipment. The reason why the number for it is negative is because this represents a cash outflow. So PepsiCo spent about $2.9 billion of cash buying new property, plant, and equipment, which is a lot more than the $115 million it got when it sold the old property, plant, and equipment. They purchased some short-term investments and sold some, but overall, it's the capital spending that accounts for most of the cash used for investing activities of $4.9 billion. Finally, we can look at cash flows from financing activities. It has to do with issuing and repaying long-term debt, the principal portion, and transactions with shareholders, whether paying dividends to shareholders, buying back shares, or whether it has to do with issuing new shares. So for PepsiCo, it appears that a lot of the cash used for financing activities went to the shareholders. When dividends were paid to shareholders, common shareholders, preferred shareholders, and holders of restricted stock units, which is a way of compensating executives, and a lot of, even more than dividends paid to shareholders, shares were repurchased or bought back from shareholders. This is the purchase called the purchase of treasury shares in the textbook. So overall, even though PepsiCo generated a lot of cash, $10.5 billion from operating activities, it used about half of that in investing activities, $4.9 billion, and it used a lot more of that in financing activities, causing a decrease in cash of $3.2 billion in 2014. Cash and equivalents started the year at $9.4 billion and ended the year at only $6.1 billion. Let's analyze the statement of cash flows, first with a liquidity ratio measuring the short-term ability of PepsiCo to pay its obligations. The current cash debt coverage ratio gives us net cash provided by operating activities from the statement of cash flows divided by average current liabilities on the balance sheet. Cash flows from operations we got from the statement of cash flows, current liabilities this year and last year from this year's balance sheet. To get them for 2013, I looked at the 2013 annual report to get 2012 current liabilities, and we calculated that cash flow from operating activities was not quite enough. We didn't generate quite enough to cover our average current liabilities in either year. For every dollar of current liabilities on average, PepsiCo generated 58 cents of cash flow from operations in 2014 versus 55 cents in 2013. Using the current cash debt coverage ratio, PepsiCo was slightly more liquid in 2014. In my opinion, getting closer to 1 or being able to cover your short-term obligations with your cash generated within one period is a better ratio. We'll look at a ratio of solvency, the ability to pay your creditors over time and to purchase long-term assets. One is free cash flow. Do you generate enough cash from your operating activities to pay for any capital expenditures, purchases of new property, plant, and equipment, and to pay dividends to share profits with your shareholders? All these numbers are from the statement of cash flows, but from different sections. So the first is the subtotal net cash from operating activities, which in 2014 was $10.5 billion. The capital expenditures is just one item from cash flows from investing activities. In 2014, this was $2.9 billion, and cash dividends was $3.7 billion. So PepsiCo, even though the cash went down in 2014, it did generate enough cash from operating activities if the only thing it used the cash for was to buy property, plant, and equipment and to pay dividends. PepsiCo, of course, used a lot more cash to buy back shares. With this number, it's not a ratio, it's a dollar amount, so you can only compare one company to itself over time. So PepsiCo generated $3.9 billion of free cash flow in 2014 versus $3.5 billion in 2013. It was more solvent because it had more free cash flow in 2014 to repay longer-term creditors after paying for capital expenditures and dividends. So please feel free to use this video as a review before looking at your company's statement of cash flows and calculating current cash debt coverage ratio and free cash flow. The discussion will help you compare your company to another in the same industry or a different industry. Good luck and get started, Jaspers.